Hi, this lecture is about financial statements and analysis. It's mainly divided into two main parts. Part number one, which is related to financial statements, a very brief description of each one of them, and number two, the key financial ratios that can be used in order to analyze or assess the financial condition and performance of the firm. So let's start with financial statements. There are four key financial statements. They are income statement, balance sheet, financial statements, a statement of retained earnings. Okay, let's start with number one, which is the income statement. Income statement provides a financial summary of a company's operating results. During a specific period of time. They are prepared annually for reporting purposes, but also can be computed monthly by management or quarterly for tax purposes. So it can be reported monthly, quarterly, or annually based on the purpose of reporting. So it's like a summary of sales revenue, any costs that have to be paid, such as cost of goods sold, in order to calculate gross profit. And then we have to deduct any expenses, such as selling expenses or lease expense, depreciation, etc. Then we have the total operating expense. From this we can calculate the operating profit. And then deduct taxes or interest in order to find finally the returned earnings and returning earnings per share. So it's like a summary of all sources of income and expenses for the government, for the corporation, in order to find the net profit. So this is number one. Number two, balance sheet. Balance sheet is a summary of a firm's financial position. At a given point in time. It is divided mainly into two main parts: assets and liabilities, plus capital or owner's equity. Assets, what the firm owns. And with respect to the liability side, it is liability and equity. Equity is owner's investment, and liabilities, what the firm has borrowed. The two sides should be equal to each other. The asset side should be equivalent to liabilities and equity side. Number 3, statement of returned earnings. It summarizes the net income earned and the dividend paid during the year with the change in returned earnings. So this means it's like a summary of the returned earning at the beginning of the year or a specific period of time, say January 1st of January 2021, and then we have to add net profit after tax minus cash dividends, preferred stock or common stock. This is paid during the year, the current year. Cash dividends. And then we have to find the closing or the end of year returned earning balance. So this is the returned earning statement. Statement number 4 is the statement of cash flow. A statement of cash flows provides a summary of cash flow over the period of concern. usually 1 year or at the end of the year. These statements provide insights into companies' investments, financing, and operating activities. In addition to, it shows the difference between previous and current balance sheets. So it ties together income statement and previous and current balance sheet. So it starts with cash flow from operating activities, all operating activities such as depreciation, increase in account receivable, decrease in inventory, etc. The second part is related to investment activities, so it's cash flow from investment activities. So it's related to growth in fixed assets or a change in equity investment, etc. And then part 3, which is related to cash flow from financing activities such as decrease in or increase in notes payable, a change in stockholders' equity, dividends paid, etc. And finally, the summation of the 3 parts together, we will get the net increase in cash and the marketable securities. Now we are going to move to the second part of this chapter, which is related to using financial ratios. Or in other words, ratio analysis. Ratio analysis involves methods of calculating and interpreting financial ratios to assess a firm's financial condition and performance. So mainly we have to use ratios in order to assess the firm's financial condition and performance. It's of interest to shareholders, creditors, and the firm's own management. Cautions when using ratios. Number 1, ratios must be considered together. A single ratio by itself means relatively little. So we have to calculate different ratios for different things in order to be able to interpret the financial condition or performance of the firm. Number 2, are going to compare financial statements over two different years, it should be at the same point in time. Say, for example, we are going to compare financial statement in 2020 and 2021, so they must be in both of them in Jan, for example, 1st of Jan, or at the end of the year, say in December. Okay, so they must be at the same time period. We have to use audited financial statements. Number 4, the financial data that's going to be compared should be developed in the same way. So this means if you are going to calculate any ratio or any financial data and compare this financial data between two different years, this financial data should be calculated using the same way, the same rule, the same mathematical form. Okay, so these are the 4 main steps that should be taken into consideration while we are going to use financial ratio analysis. Ratio analysis has a number of ratios or classifications. Number 1, liquidity ratios. There are a number of ratios that are related to the liquidity of the firm. Activity ratios. Number 3, leverage ratios, profitability ratios, and market ratios. Let's start with number 1, which is liquidity ratios. We are going to talk about 2 main liquidity ratios. They are current ratio and quick ratio. With respect to current ratio, it's calculated as total current assets of the firm divided by total current liabilities. This can be found in the firm's balance sheet. With respect to quick ratio, it's calculated as total current assets minus inventory divided by total current liabilities. Let's take an example. If you are given the following balance sheet, this is assets, cash, marketable securities, inventory, account receivable, prepaid expenses, total current assets, PP&E, total assets, and then liabilities, current liabilities, long-term debt, retained earnings, and total equity. Now we have to calculate the liquidity ratios. Number one, current ratio. As we said, it's calculated as total current assets divided by total current liabilities. From these balance sheets, this is total current asset and this is total current liabilities. So it can be calculated as 315 divided by 80, which is 3.9. Number two, quick ratio, which is calculated as total current asset minus inventory divided by total current liabilities. So it will be 315, which is total current assets. Inventory is 80. Sorry, it's 100. So we can calculate it as 315 minus 100 divided by 80. It will be 2.69. So this is the quick ratio. So what is the importance of the liquidity ratios? Liquidity ratios help to determine the ability to cover short-term obligations. So the higher the ratio, the better the ability of the firm to meet their obligations. So if it's greater than 1, it's much more better than less than 1. Number 2, determine credit worthiness. So this helps creditors to identify whether it's possible or they have to extend credit to a company or not. With respect to investors, low liquidity ratios raise a red flag. But the idea that the higher is better is only for some extent. It's not forever. The higher is better up to a certain limit. So a very high ratio, a very high liquidity ratio, means that the company holds a large amount of liquid assets. So it must be appropriate levels, not very much high, very much low. It's somehow in between, in order to be able to meet its obligations. At the same time, it's not too excessive or very large amount of liquid assets. Okay, this is the end of our lecture, and see you next week.